This envelope reversion strategy outperformed the Nifty 50 by over 100%. In this video, I'll break down how the strategy works, its complete risk framework, and the structure that allowed it to outperform the Nifty 50, and watch till the end to see the complete backtest results. I'm Kaushal, founder and CEO of CastleGate Capital, a SEBI-registered investment advisory firm that builds products focused on quantitative investment and trading strategies. The envelope reversion strategy is built on a simple belief. When a stock is in a strong long-term uptrend, its short-term pullbacks are often temporary dislocations, not breakdowns. Instead of chasing strength, this strategy waits for weakness inside strength. It looks for high-quality liquid stocks that are still trading above their long-term trend, defined using the 200-day moving average, but have temporarily fallen below their short-term equilibrium, defined using a 20-day moving average envelope. That moment of overextension is where the strategy enters, aiming to capture the move back toward fair value. Every CastleGate strategy comes with complete documentation. Its structure, logic, and parameters are fully detailed in the strategy document, which you can easily access by clicking the link in the description. Just like the breakout strategy focuses on waiting for a confirmed surge instead of reacting early, this system is also built to be selective and disciplined. The difference is simple. This strategy buys controlled pullback, not breakouts. Each trading day begins by constructing a high-quality universe from the Nifty 500, filtered for strong liquidity and scaled toward a large cap-dominated basket. This keeps execution clean and avoids erratic, low-quality names. Once the universe is ready, the system tracks every symbol using three core daily indicators: SMA 200 to define the long-term uptrend filter, SMA 20 to define the short-term mean reference, ATR 14 to define volatility and position sizing. At 9:20 a.m., the strategy evaluates entry signals across the entire universe. A stock qualifies for a long entry only when two conditions fire together. The first is the mean reversion trigger. Price must fall below the lower envelope, defined as SMA 20 minus 2.5% of SMA 20. The second is the trend filter. Price must remain above the 200-day moving average, ensuring the stock is still in a structurally bullish regime. Only when both conditions align does the strategy trigger a long entry. This ensures the system buys pullbacks only when the larger trend is still intact, avoiding any attempt to catch falling knives. Once in a position, the strategy does not churn. A strict no re-entry rule applies. If a symbol already has an open position, the system will not open another one in the same stock. Unlike the intraday breakout strategy, which force closes all trades at 3 p.m., this strategy is not intraday. It can hold positions overnight and exits only when one of its rule-based exit triggers occurs. Every day at 3, the system performs an exit evaluation across all open positions using a fixed hierarchy. The highest priority exit is a trailing stop. Once a position crosses plus 6% profit, the system tracks the peak price since entry. A trailing stop is placed 1% below the peak. The stop only tightens upward and never loosens. If price falls to or below that level, the position is exited immediately. The second exit is the envelope exit. If price rises above the upper envelope, defined as SMA 20 plus 2.5% of SMA 20, the strategy exits, capturing the mean reversion back into equilibrium. In addition, hard risk exits are always active, enforced through Wizzer's risk model layer. 4% hard stop loss, 12% hard profit booking. At the portfolio level, the strategy follows a strict and disciplined risk framework designed for controlled swing trading. A maximum of 5 open positions is allowed at any time. Before placing every order, the system checks live holdings and blocks new entries if the limit is reached. Each trade uses ATR-based volatility sizing. Risk per share modeled using 2x ATR 14. Position size bounded between 1% and 15%. Total portfolio exposure is capped at 98%, preventing overallocation. By requiring long-term trend confirmation, short-term overextension, indicator readiness, and liquidity-controlled universe constraints, the strategy avoids low-quality trades and prevents random dip buying in weak stocks. This envelope reversion strategy was built by CastleGate and backtested on Wizzer's institutional-grade infrastructure. This strategy was tested over the previous 1-year period, during which the Nifty 50 delivered approximately 11% returns, while the envelope reversion strategy generated around 26%, resulting in over 100% relative outperformance versus the index. From a risk standpoint, the strategy experienced a maximum drawdown of around 12%, achieved a Sharpe ratio of 0.89, a Sortino ratio of 1, and maintained a profit factor of 1.5, highlighting a strong risk-adjusted performance profile. It participates in mean reversion only when the larger trend is still intact, with risk controlled at every level. At CastleGate, we are open to helping you make the most out of our strategies, whether that means understanding their core principles, testing them hands-on, or entrusting our team to manage them for you. Connect with us on WhatsApp for personalized guidance, or set up a session with our team through the Google Meet link in the description below.